You get up to about 34.95 and close the week there. And that momentum indicator I told you about says you're gone up. Price says you're exploding if you touch 36, triple top breakout. You see those and I think you could almost double silver in a fairly short period of time, probably within 1 quarter.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 2nd through June 9th, 2025, while supplies last. First this week, we feature backdated 1/10-ounce gold maples at just $39.99 over melt. Next, the very limited 1-ounce silver Engelhard Prospector rounds from 1982 to 1986 are just $4.79 over spot. 1-ounce silver Asahi bars are just $2.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you today. Today, we're seeing some increased trade tensions between China and the U.S., and gold and silver seem to be reacting pretty dramatically. Silver up more than $1 and gold up about $80 or so. Your take on this recent move today?
I think that the trade issue is, of course, we know it's recent. Okay, Trump gets elected, and even then it wasn't a topic. It was only a few months later that it became a topic. I think it's a focal point that is, it's real and it's impactful, but it's not the prime driver of the markets. I think the prime driver of the markets is far bigger than that. I think it's monetary degradation. It's a government debt crisis that we're facing. Jamie Dimon spoke about that, the other day. Other people have said so as well. I think even Warren Buffett said, they would watch out for the U.S. government bond market. And that market we analyze closely, and obviously, it's bigger than the stock market. Okay, U.S. Treasury long end of the debt market. So it's very anemic. There's something wrong with it. In other words, back in 2020, when the T-bond futures were up at 170 and yields were real low, we got bearish in October of 2020. Well, it collapsed finally into 2022. Took a while to get going, but it finally did puke and got down to 117 from 170, 180 level. But since then, we're talking late 2022, you could just draw a line sideways. And it's tried to base, it made lower lows than that low since 2022, but only, it got down under 110, for example. Right now we're trading 112 on the nearby future. So it's very anemic, though. If this is a base, which we thought it might be several months ago, we had some technical reasons to assume you could get a strong counter trend rally out of T-bonds, meaning a drop in yields on the long end of the debt market, which is the one the Fed doesn't control. And sure enough, we got a rally. If you'll notice, back in April, we shot all the way up to 122 on the T-bonds from levels that had been hovering around 10 points below there. But in 2.5 days, it crashed from 122 back down into the 111s. Whoa, what happened? So instead of being an alternative to the stock market, it joined it. Now, in the week since, and the stock market has rebounded, bonds have stabilized, but they've not really gotten off the mat. They haven't gone down anymore, but right now they're going back down again. And when we look at the long-term charts, we know it's a negative trend. And we've given up on the notion of a, quote, counter-trend rally, where you get, let's say, a quarter or so of nice rally in the T-bond market as an alternative to stocks. Well, if T-bonds aren't an alternative, if they're not functioning that way, the 60-40 rule, which has now been broken fully, then that leaves only one alternative: gold. Historically, gold and T-bonds have tended to rally, advance during stock market bear trends. And the only one advancing now is gold. Well, why? Okay, forget the tariff issue. the government debt issues ballooned and ballooned decade after decade. It doesn't matter, Republican, Democrat, it just piles up. And the debt ratio, and so forth. We all know this. But nothing's ever really happened in terms of generating a debt crisis. And I don't mean mortgages this time, I'm talking U.S. government debt. What if we're at that point now, where finally, after decades of ignoring and building on this error, the market says, okay, I'm going to pay dues. In which case, you've got a T-bond crisis. Now, what does that mean? Well, if the U.S. government debt or any other major central government's debt in the Western world, including Japan, let's say, and Europe, suddenly becomes a crisis, it takes a heck of a lot of money printing to try to stave that off, to try to keep that wave from crushing things, okay? And Powell likes to sit here and diddle his thumbs and act like, well, nothing's wrong because all the data points look good, which is, you get the point. They've got a problem. And the question is, what are they going to do about it? And what they do about it is to do what they normally do, which is to put the pedal to the floor, do QEs, buy government debt themselves, play games, et cetera, et cetera. But ultimately, it's an increase in the money supply, artificially low interest rates, all the things that are drivers for gold, and the degradation in the money unit that we measure things by, the dollar. And I don't mean degradation of the dollar versus the euro, dollar versus, I'm talking about the real buying power of the money unit, which, if you double its money supply every decade, which is about what we've done for the last 70 years, ultimately it means its buying power gets cut in half every decade. And meaning you could have a world where we're in Venezuela, where it really doesn't matter if everything's going up. So the stock people could say, oh, look, our stock market's booming, like in Venezuela where they print the money. It doesn't matter. It's the issue is what rate does it go up compared to the degradation in the money unit? So even then, at that point, when you reach that crisis level, it's conceivable. We don't think it's going to happen. We think stocks are headed down. But when they start printing money, the question is, will it become like a Venezuela situation? Whereas we have a crisis beyond crises, which means political turmoil, upheaval, not just here, but we're talking the rest of the world, which has similar problems. So that's what's driving gold, I think, and silver. And right now, I think that my own personal emphasis is on silver. As I said to you before, we watch the mama market, gold's the mama. But as long as old gold mama is going up, you can bet silver's going to go up in irregular fashion, more than gold, less than gold, more than gold, et cetera. I think we're at the phase now where it's about to go a lot more than gold on the upside.
And what kind of levels are you looking for in silver? I know we've broken through 34. We did, I believe, a few months ago, touch the 35 level, but it really hasn't sustained any level really for a decade above 35 here.
Yeah, no, we made a high. Actually, if you go back and look at a silver chart going back to 1970s, let's say, and you see the peak in 1980 at 50 area, which was, very gaseous type peak. And you were up there so briefly, it was thin air and then it collapsed, okay? And then in 2011, early 2011, before gold made its high, silver got up in just short of 50, like $49 or something, and then dropped and held. This time, when we're up here in the 30s, for the last year, in fact, last May, silver got up to 32.70. Okay, dropped, came back up in October, hit 35. They sold it, dropped, came back to 35 again in March this year, and dropped and had that flush where people sold silver thinking, oh, silver's going to go down because the stock market's going down, which is an erroneous assumption. And the people who sold that got killed because silver popped back over 30 in a heartbeat from 27.5, and now we're pushing toward the 35 again. Getting back to 35 is what point and figure chartists would call, triple top. Now, I use the word top. It really isn't that case. It's a pending quadruple top breakout, or a triple top breakout, excuse me. If you go up to 35 again, I'm going to bet the next tick is 36 and you're gone. That's what the price chartist at that point will start realizing, hey, this action of the last year in silver, which has been violent, but still with a slight upward bias. Go back to last May, it was 32, and earning 34 and a half, et cetera. They're going to realize, hey, we made a mistake. This isn't topping. It's been built in a launch pad. Now, I don't trust price necessarily, so price says that. The only reason I would agree with myself about that 35 being a pending triple top breakout or a launch pad is that momentum says it is. There's a momentum structure when you plot a momentum oscillator of silver, where you measure silver versus like a 3/4 moving average or a 40-week average. You'll have a corrective process since last year, since last May. So 12 months of momentum cooling off while price held steady. And there's a structure on it when you look at the momentum chart that says, ooh, if I cross that line, I'm going to blow through. We're challenging that line right now. About another 50 cents above where you are now, you're gone. I think the first leg in silver is highly likely to take out the old dual highs at 50, which again are really phantom historic situations. They don't mean much. They were decades ago. And go probably surge into the mid-60s or 70 zone, somewhere in there, before it even pauses. Now, I don't mean that's the top. I'm talking about this next gush could be a tremendous move, meaning a near double in silver from current levels. The key is to get up through today's high, which is like last I saw before we came on, was 34.65. You get up to about 34.95 and close the week there, and that momentum indicator I told you about says you're gone up. Price says you're exploding if you touch 36, triple top breakout. You see those, and I think you could almost double silver in a fairly short period of time, probably within 1 quarter. And again, that's not the top, that's not the end of the move, that's just getting up out of this historic silliness. Gold, after all, is well above those levels, right? Made a high at 850 in 1980, made a high at 1920, 2011, and it's 3,500 area. So silver hasn't done that. Now, silver to sort of match that would be up, $60, $70 level. Anyway, that's what I think is about to happen.
This is how bull markets typically turn out for precious metals. The silver really catches up at the last minute. And we've seen gold, it seems like outperform over the last year and a half or so. But it sounds like you're saying within the next couple months or so, we really could see silver really take the lead.
Also, the gold and silver miners. My personal emphasis in my own trading is long gold and silver miners, long silver. Watching gold is the mama, but again, I think those two categories, subcategories of gold, we know they've underperformed for the last 3 or 4 years. Then that 2020 price surge we had in gold went up to 2,000, silver went up to near 30, and the gold miners, GDX, went up to 45, I think it was. Then gold sort of went sideways for a couple of years, but silver and the miners went into a staircasing decline. So since 2020 through the present, the spread relationship between silver and the gold miners in gold has been underperforming. Technically speaking, they look like they're ripe to turn up. In fact, the gold and silver miners right now are on the edge of breakout. In other words, if you plotted that action, the spread action since 2020, so fairly long time, there's a structure on the chart you can see, and you're trying to break through it right now. If you do, it'll validate what I'm saying, further validate it, that the place to be is silver and the gold and silver miners. And I think they'll gush a lot more than the upside than will gold. I don't think that we're in a normal bull market. I'm not saying that you've got to go a lot higher than the other ones did. I mean, even if you just matched the prior gold bull markets, which were 8-fold moves from bear low to bull high, you'd be $8,000 gold just to match those peaks. The $850 peak versus its $100 low that preceded it, or the, et cetera, et cetera. But the reality out there, aside from just markets, like political reality, economic stability, monetary notions, institutions that have helped create this crisis, like central banks monopolizing the production of money, that could end. And I think we'll end up in quite probably a gold, silver world again, where it's money, it's legal. It can't be printed overnight at the will of government to pay for this program or that program. By the way, I noticed the other day, Florida, of course, legalized gold and silver as tender, as legal money. They're like the dozenth state to do that in the U.S. Now, when a state government legalizes a new money, gold and silver, in effect, that's saying to the central government, we're seceding from your monopoly control over what we call money. We're allowing gold and silver to compete with your, quote, legal tender. So in a form, that's a form of rebellion, quiet and peaceful, but it's a way to say, hey, you know, we're tired of your money. It's not stable. It's never been stable. It's always been degrading in value. We're allowing the public to use gold and silver as legal money. And even some of the states are allowing you to pay taxes with that. They're setting up agencies to be able to accept gold or silver in payment for taxes. So that's the kind of rebellion I'm talking about that occur globally, where there's a transition among the more foresighted countries that we need to get away from this stuff. It hasn't been working. And so I think that means that when you get up there, you just stay up there, because that may be the new priced reality of, you get the point.
Definitely. I mean, the amount of currency out there at the moment versus the amount of gold and silver at the moment, I mean, you'd be looking at those sky high prices, as you mentioned there, that it might be shocking to a lot of people who are kind of just getting into this space that we could see prices for gold and silver that high. But really, I mean, the logic seems pretty sound, what you're talking about from two different avenues there.
Yeah, again, it's not high because, yeah, in nominal terms, $8,000 gold versus $1,920 gold. If we went to 8,000, an eightfold move from our bear low, which is 1,050, 2015. You think, well, that's crazy. No, it's not. It's just doing the same thing it's done twice before, eightfold moves. Now, but again, I'm not sure that's going to stop it. I think this bull market, one, is going to possibly go beyond that because of the nature of the government debt crisis. Remember, in the prior bear markets, we had a dot-com bubble, okay? It spun itself, 82% drop, and the NASDAQ 100 took it 16 years to come back to its old high. You know, so it was a wipeout. But it was a market situation. Yes, facilitated by monetary manipulations and so forth over the prior years. It created that bubble. And then we had the other crash, which was the 2007-9, but that was mortgages. Now we have government debt. And that's a different monster because the central banks can't just thumb their nose at it. They have to come in. Otherwise, you know, I won't tell you what's going on the streets. You can't have that happen. So the question is, when are they going to push the button? Or are they already doing it? Some indications are that they are already intervening in the markets, especially the T-bond market. And when you look at the tonal action of that market over the last specials of the last 6 months or so, when it tries to drop, it suddenly seems to find a floor. It can't get off the floor, but it seems to find one, and it bounces, it keeps coming back down. Right now, again, bonds nearby future, which we treat as a September contract, is 112. Okay. You get down much under 111, like 110 area. It's a couple points, no big deal. It could implode. And that's when you'll have real panic on the part of the central government, meaning monetary excess, like possibly we've never seen. So again, what does that fuel? Gold.
Now, I've also been looking very carefully at the gold-silver ratio, and I know you analyzed the silver-gold ratio. What is that telling us right now? Because I'm seeing, for example, on the chart that it is falling as we're seeing both metals rise today.
Mm-hmm. It upticked last month, and we got down below 1%, meaning if you divide an ounce of silver into an ounce of gold, the April closing level of that spread was like 0.9 something percent, less than 1%. Now, historically, you go back 50 years or so, and the number of times you find that silver prices, 1 ounce of silver is, 1% of the price of gold, is very rare. And whenever it does it, it's a buy. I mean, and if you go back and you found those times and circle them, somewhere around that time is a major buying opportunity for the net price of silver. Because when that spread goes up, it's always the case that it's silver going up more than gold, not gold going down more than silver, if you get my point. You could have the silver-gold spread favor silver in a bear trend, but it doesn't work that way. It never has. It's always the case that when that silver outperforms gold, it means they're both going up, just silver more. Technically, when we analyze the spread action, not just look at the chart superficially, right now we're back above 1% again. We had a slight up month last month in the close of May, slightly upticked from the, not enough to change the tide. You get back above 1.1%, which is not asking a lot. Wake up, because that indicates that probably it's starting its turn. You ever get above 1.32%, you can write this down if you want. Divide an ounce of silver front month active contract into gold's front month active, and you get it up to 1.32% or higher. I think you could gush to 2% in a heartbeat. Now, what does that say? Well, if you hit those trigger levels, that's basically a doubling in the current price of silver versus gold. So if gold ever went to 8,000, it's normal, eightfold move again, and silver would doubly be $160, 2%. So you get the point. I'm not projecting that as a price. I'm just saying that's the kind of dynamics we're dealing with here. And we're very close to signaling that type of turn, both in the miners versus gold, which I said we're at the structure now, or in fact, we're probably crossing it today, and silver versus gold. And quite often, as you pointed out, it's later in the bull trends that we see that type of behavior where they go berserk, more so than gold. And I think we're on the cusp of that.
Right. And as we see, and you've mentioned, this could happen as quickly as in 1 quarter, right? The movements where silver outperforms is dramatic, and it is super, super fast.
I don't think it's this kind of arm wrestling, 3 steps up, 2 back, 3 steps up, 2. It's more like 5 steps up, half back, 8 steps up, et cetera. A change in the price tenor and tone will accompany the shift in these spreads as well.
And one thing that really drives, as you've mentioned, gold and silver prices is, a concern over the U.S. bond market and over the financial system and trade imbalances as well. I did want to ask you about the banking system, as we often do touch on in these interviews with you, because if the bond market is having trouble, then that might signal also trouble to the banking system. So can you give us an update on this?
Could, yeah. The banks, okay, the lenders, okay. We're watching particularly commercial real estate, not home mortgages and stuff. We know that's hurting, and we know it's the high yields are discouraging new home building and so forth, because it's, that's the end of the market that matters. But commercial real estate, there's 2 ETFs, RWR and VNQ, that cover the commercial real estate holdings. And they both tend to be technically in sync with each other, those 2 ETFs. They first off, they're much heavier than the stock market in terms of what they've done over the recent years. Like when the S&P went up finally and took out its 2022 price high, which was 4,800 level, and went all the way up to 6,100, pulled back to 4,800 recently, by the way, for a bounce, which we expected. If you look at RWR, VNQ, they never even approached the 2022 high. They rallied with the stock market, but they were still well below the high that the market general made in 2022, from which it declined. They declined too, but they never even got back to the 20. So they're very anemic. We understand, and I don't look at the fundamentals, but I hear analysts who know the sector. The debt there is a very big problem with commercial real estate. In fact, about 2 months ago, we had, I think, the largest shopping center in the country or something. It was, forget the name of it, New York, that defaulted on $300 million in debt. Okay, so, it's that kind of thing that could then shin kick the banks. Now, of course, the Feds are going to be there, okay? The banks are part of the deal, they're part of the club. So they'll come in, but still, that's an area to watch because it will indicate the internal consequences of high yields. Which these high yields on government bonds are impacting commercial real estate. Debts are due now. I understand a lot of the debts with commercial real estate are due in 2025, 2026, and the yields haven't dropped. And so they're choking. And that could lead to a domino effect. So yeah, I would watch the banks, but again, watch commercial real estate because it's likely to be the domino that hits the banks. And it's an anemic sector.
I've really been hearing, concerns with respect to commercial real estate. And it doesn't seem like, the trajectory, if you just think of a lot of more people working from home, people aren't going into the office as much these days. It does not seem like there's an alternative use or that there is going to be future use for these old buildings out there.
Yeah. I forget the details of it. There was some big, huge old office building in St. Louis. I think the whole thing sold for like the price of a rich house. And anyway, you're right. Yeah. So reality's changing, and we have these cadavers, the skyscrapers. Anyway, yeah. It's that reality, the long-term government debt market, the bond market, U.S. government bond market in particular, is impacting this private debt, and therefore I don't see a recovery out of it. I don't know how they're going to get out of it as far as commercial real estate goes. They'll have to change the nature of their reality that they deal with. And the long-term debt they've got is just not getting better. And if this T-bond market doesn't stop, and I think Buffett and Jamie Dimon have both said, we're negative on this, and we've been, I agree. That's a crisis, and it's a monster. We're talking U.S. government long-term bonds. They're bigger than the stock market. So pay close attention to their tonal and behavior, because they look like they could, if they don't stop here shortly, they could have a spike to the downside that would upset the heck out of people, including the central bank. So, I don't know. Of course, Powell's created he's got his own problem because Trump says cut rates. Trump has always been that way, print money. Okay. And it's one fallacy in his intellectual structure is he believes, he told the Fed back, years ago when the last year in his term, take rates to zero or lower. If Europe's got them real low, we can should go lower. So, he believes in that. And he's pounded Powell in the head about this. And Powell, of course, has to resist because otherwise he looks like he's a puppet. And so by delaying, it compounds the situation. It's going to be interesting. But again, this is a crisis different from the other bear markets because the factors that are engaged here are much bigger. The bubble in the stock market is much bigger. It's much older. It's 15, 16 years old, far bigger than any bull market we've seen. And if you look at a money supply chart or the Fed funds rate chart, you can say, oh, I can understand why. It got printed higher,
It really seems like things are coming to a head now, and especially as we look at the gold and silver markets, what we've talked about today, we could see big moves soon. So if our viewers are interested in continuing to track this with you, getting your latest insights and price levels that you're looking at and momentum levels, even more importantly, that you're looking at, they can go to olivermsa.com. Can you tell us a bit about that?
Yeah, we in our all asset category subscription, we cover the bond markets, stock markets, S on that, go to global, commodities in general, and gold and silver focus, and also Forex, foreign exchange market. And that's a factor as well, because the dollar is starting to, we got bearish at 104.21 at the close of March. Right now it's trading about 98 something. You go back down, touch 98 again. It did that like a month ago and then bounced 3 points. You come back down and hit 98 again. I think we start to puke the dollar, which further exacerbates the debt problem because a lot of foreign buyers of U.S. government bonds or U.S. stocks even have to buy in dollar terms. They take their currency and buy X number of dollars of this stock or UST bonds. So if the dollar starts to implode, and I think it could, very dramatically, starting if you go back down through that 98 level again, that will damage their positions very badly, more so than just the price drop in the T-bonds or the price drop in the stock market. And that could accelerate, that could be a domino factor. So watch the dollar as well, not just the T-bonds. But these are big games, and they've just begun, particularly on the dollar. Its breakage is just started in March, and I'm talking about an annual momentum trend that goes back a couple decades, where you can plot it on a momentum chart and see this massive multi-point uptrend. We broke it in March. So momentum says you're done. Price will get the message shortly. It's already starting to. And at that point, that becomes a factor that few people have factored into the markets lately. They'll start to soon. And again, that helps gold.
Fantastic. Well, Michael, we really appreciate your time today. Thank you so much, and God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 2nd through June 9th, 2025, while supplies last. First this week, we feature backdated 1/10-ounce gold maples at just $39.99 over melt. Next, the very limited 1-ounce silver Engelhard Prospector rounds from 1982 to 1986 are just $4.79 over spot. 1-ounce silver Asahi bars are just $2.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.